Hey everybody, welcome to Trading Capital's daily analysis video. It is Monday, June 6 here, jumping into the S&P 500. On the intraday action, you'll notice how we had this big gap up on an intraday basis, a little bit of pre-market trading. You initially sold off, rallied up in your early morning volume, and then sold off throughout the rest of the day. But you've pretty much been everywhere but nowhere today. There's been lots of chop on the S&P 500. In reality, it is kind of still holding that daily chart bullish consolidation. And in our previous video, we said we wouldn't be surprised if we saw the S&P chop and consolidate sideways for a couple days before it breaks higher. And it will only break higher if it manages to hold the bull flag pattern on the daily chart that we have been monitoring. So currently heading into the close here, you can see the S&P 500 is struggling to get above this intraday 20-day moving average, 25-day moving average. So that's obviously a decent sign of resistance. Notice how we came up to the high here, but we failed to fill this gap up here. And we also failed to fill this gap down here. We came very, very close, but we have not filled it on a technical basis. So if we flip to the daily chart, let me just erase those intraday lines. If we flip to the daily chart, notice how, again, we're still holding this inside bar bullish consolidation. We marked this bull flag pattern over here, and we said, don't be surprised if we chop for a couple days in between this bull flag pattern. And if we hold this, it does favor a move up into this resistance over here around this 428 level, which is a key technical gap fill. So we are still in the camp that you do have a push up there. Now, one of the reasons the markets have been very, very choppy is for the simple fact that the yields, the US 10-year has popped up. Today, the US 10-year is up over 3%, and it's up over 3% on the day, and it's closing above 3% on the day, so it's a little bit ironic. But nonetheless, this bull flag pattern, what you want to see is another 1, 2, 3, 4, 5. If we see another sideways day tomorrow, then it stands to suggest that Wednesday we do have a likely shot of breaking up higher. Now, there is always a chance that we can come back lower and fill this gap and fill this gap. Don't be a major buyer of this gap over here, as we are consolidating above it and it won't hold as much support as one would typically think. So we'll just have to keep monitoring this on a intraday and daily basis. Notice here on a daily basis, you tried breaking above this on the S&P 500, but you came selling back down. So again, this sideways consolidation after a strong move up over the last several trading sessions here is not a bad thing. It's actually very healthy for us to witness and see a consolidation pattern take effect. And that 6th day tomorrow will actually be a beautiful consolidation pattern, priming the S&P for a potential breakup. Now, on Friday, we do receive the CPI number. So I think since yields have popped today, it is kind of, the markets are kind of, or the bond market at least, is kind of pricing in a little bit of a higher inflation number than expected. And that may come on the back due to the fact that oil is still popping up higher. Same thing with natural gas and other commodities. If we flip to the natural gas chart, natural gas was clearly the big winner of the day. Massive. It was up over 10% at one point. Right now it's trading around 9.5% up on the day. So clearly not good for our short. But we have to ask, why did natural gas pop all of a sudden on this Monday? Well, it was simple. For one reason, the EIA came out with a headline, and essentially their headline that they released today was record US natural gas demand this winter led to the largest storage withdrawal in 4 years. So headline news is never a good thing to trade off of, especially when I think the smarter money has priced it in. If you look at the volume, when you have such a powerful headline like that, and if it was larger money buying in, you would have had this volume explode to the upside. Yes, natural gas has popped up significantly. It hasn't taken out the highs, but on such a powerful headline, you would expect it to have a big move. But when you actually dissect the headline, it is taking into account the last drawdown period from November of 2021 to March of 2022. So essentially, the 5-month period there was a massive drawdown of roughly 2,264 billion cubic feet. And the interesting thing about that is when you factor in what we currently have in storage, we have 1,907 billion cubic feet currently in working natural gas reserves. And with the last natural gas drawdown cycle being our largest drawdown cycle in over 4 years, our building inventories are not far off from meeting the previous largest demand in natural gas drawdown. So currently we have 1,906 billion cubic feet in reserves. If we were to draw down another 2,264 billion cubic feet like we did on the last natural gas drawdown season, that currently only leaves us shy of roughly 356 billion cubic feet shy. Considering we still have until November to build up that inventory, we have a plenty of time, in my opinion, to keep stocking and building the inventories necessary to meet that overall supply-demand crunch. And when you factor in the difference of what we currently have in stores right now of 1,906 billion cubic feet, and when you subtract it from the largest 4-year drawdown in natural gas, which was last year, we have a net difference of minus 356 billion cubic feet, but yet we still have 20 weeks to build our natural gas inventories. And when you factor in last week alone, we built our natural gas inventories by 90 billion cubic feet. Roughly over a 20-week period, we would only have to build our natural gas inventories by 17.8 billion cubic feet. But last month we did 90 billion cubic feet. So I think, again, the markets especially the retail traders are hopping on the bandwagon of these headlines, and it's never a good thing to chase a commodity that has rocketed, had a parabolic move already, and then you start piling in and chasing it at the near the all-time cycle highs of this cycle. So when you factor in that we realistically only need to build our natural gas inventories by 17.8 billion cubic feet for the next 20 weeks, that is definitely a task that we are going to crush by a foreseeable margin, in my opinion. Considering, I think the lowest build I think we had was 55 billion cubic feet, it stands to suggest that 17.8 billion cubic feet is nothing for us to build on a weekly basis. And we'll just have to wait and see on Wednesday when we receive the newest EIA data. So again, you'll notice how natural gas gapped up right into this longer term resistance over here. It has not managed to close above that resistance. It has not managed to close above this cycle high here. In the event it does, you still have these two wicks as your major resistance. If it manages to get through that, you'll have this 967 as short-term resistance, and then ultimately the top of this channel around the $10 mark as resistance. But just crunching the numbers off of the EIA's data alone, it really doesn't make sense, this headline, in the sense as to why natural gas popped so much. Sure, it's a record drawdown over the last 4 years, but we are now well in effect in terms of needing to build our inventories to meet the overall supply crunch, even with the war that's transpiring and going on. And then when you factor in the economic conditions and we're still set to tighten, growth is slowing down, I still favor a bigger downside move in natural gas. Sure, natural gas is taking a little bit longer than I'm expecting to go down, but inevitably the economy is slowing, and with the Fed now, I think, going to move more aggressively to tighten faster, since unemployment numbers and the economy is, in their opinion, following one of their mandates and stabilizing, I do think that we will see that pullback eventually coming. I can't tell you the exact date, no one can, but when you're breaking down the numbers, our inventories are still in line to meet the overall demand that natural gas poses. So we'll just have to keep monitoring that as it is. We did add a little bit of a short to it. We did add to our UNG short today, so we'll just have to keep monitoring that. And I think what we're witnessing is that whenever you mostly see a down day in oil, that money is rotating into natural gas. And when you see an up day in oil, natural gas is generally down. So it's kind of this institutional or retail shuffling of money going back and forth from the two energy sectors. When natural gas is weak, oil is strong. When oil is weak, natural gas is strong, vice versa. We're kind of seeing the shuffle between these two safe haven commodity plays. And just like we've seen before in the previous recessions and collapses, energies have always been a flight to safety because people think, oh, it's something that we're going to continue to use and need. It's a staple. But energies always fall twice as fast when that inevitable slowdown comes. I don't think we can really fight the Fed on the demand destruction that they're going to create. And obviously there's a lot of debate around the poor energy policies that we're witnessing in Europe and North America. So that is obviously creating an underlying bid around the so-called energy sources. But in my opinion, the biggest macro driver is going to be central bank policy. And when you have central bank policy around the world on the same boat, tightening, it's inevitably going to lead to a recession. And that's certainly what a lot of data points that I'm seeing as I monitor sectors and economic data across the board. But let's just wait and find out what happens with the latest CPI number. I think if the CPI number comes in hotter than expected, then that's certainly going to put pressure on the Federal Reserve and other central banks to start to think about potentially tightening faster, maybe even seeing that 3/4 basis point Fed fund rate hike. Instead of 0.5, we could see a 0.75. That would certainly shake the markets up very, very quickly. Taking a look at the QQQ, let's take a look at the QQQ. So the QQQ, again, you're still consolidating sideways in this bullish inside bar bullish pattern. Really nothing more to report. We did go over our resistance levels. You have this gap fill up here. You'll have a little bit of short-term resistance at this yellow trend line over here around the 317 mark. So we'll just have to monitor that on an ongoing basis. If we take a look at gold, gold did get hit today because of yields as well as a stronger US dollar. So taking a look at gold, gold has had two nasty down days in a row, and it's starting to see a little bit of a change in its pattern. And I think if yields continue to push up, obviously that's going to strengthen the US dollar, which will inevitably put pressure on gold. We are long the GLD still. I do think the GLD over time goes a lot higher, but we'll just have to monitor that as we go. I do think yields have had a pretty strong run, so let's just flip to the US 10-year. You can see, whoops, sorry, let me just bear with me while I get this chart. So you can see the US 10-year has finally, we were talking about this parallel channel acting as resistance. You finally broke through and you're closing inside of this parallel channel. Now tomorrow will be confirmation day for yields. If you close above this channel, then it looks like you're going to test this previous high around the 3.2% mark. But considering the fact that you're on a 1, 2, 3, 4, 5, 6 day time count, it does favor a pullback coming very, very soon. Now, if the markets are continually spooked about inflation, then yields can certainly push higher. If that inflation number on Friday comes in hotter than expected, there is a chance that yields can continue to keep pushing up, but I'm still in the camp that yields will see a small pullback down to this 2.49, 2.5% mark. Let's take a look at the DXY, the Dixie, just for a perspective. So one of the reasons why gold pretty much have seen those two red down days is you've had two green days in the US dollar, so therefore you've had two down days in gold. It's pretty much a mirror image of each other, and that's why gold is certainly under pressure as the US dollar is rising. If we take a look at Bitcoin, I think Bitcoin has had a tremendous move. We were calling for more upside in Bitcoin, and it's certainly good to see that we are in the money on our position now. Forgive me for all these crazy trend lines. Let me just remove some here just so it's a little bit clearer. You can see our average here at 30,293. Bitcoin has been stuck in this wedge pattern that I've been following. So you can see this downsloping yellow trend line with this downsloping yellow trend line over here. We are trying to break out of that trend line, but you can see you just hit it here as resistance. Now what you want to see is some tight consolidation underneath this trend line of resistance before you can break up higher. If we break out of this trend line, I do think the 34,000, which will just coincide with this major pivot here, will be your next major resistance. And I do think it is a probability that we get up to that 34,000 mark. But it's good to see that Bitcoin is trying to break out, especially when the S&P and QQQ really wasn't that, they didn't perform that well today. It's good to see that the crypto space is holding up better than expected. And we'll just have to keep monitoring that, especially with yields rising. You would expect that more of the risk off assets would perform. So it's good to see Bitcoin performing very, very strongly, especially as yields rise. So right now Bitcoin's up 4.7% on the day, and we'll just have to continue to monitor that as we go. That's it for today. We'll continue to post additional analysis and videos. Thank you again for being members and subscribers.